Braxit was incorporated in 2010 with a 31 December financial year end. The company has always been registered for value-added tax and operates in the manufacturing industry. On the night of 1 December 2018, a fire broke out on the premises. Luckily, the smoke was detected by the security officer, and as a result of his quick and proactive actions, the fire was contained and only affected machinery in the one corner of the factory. The machine was damaged beyond repair, but was brand new. It was bought and installed in October 2018. Braxit entered into an agreement with the supplier to repay the purchase price of the machine over a 6-month period commencing on 1 November 2018. Good. First thing that we have to note, 31st December financial year end. Second thing is that there was a fire on the night of 1 December 2018. And then the thing that was severely damaged in this fire was a machine. And that machine was bought and installed in October 2018. Now, that machine was brand new, and Braxit undertook that he will repay the supplier for the purchase price of that machine over a 6-month period commencing on 1 November 2018. So, basically, at the date that the fire broke out, he has only paid one installment on the machine. At the date of the fire, he has paid the second installment on the machine. But it means that there was an amount of 4 months worth of installments that still had to be paid on a machine that was completely destroyed in a fire. Braxit is insured against losses as a result of fire, and the insurance claim was submitted on 10 December. According to the insurer, payment in terms of the policy will be made by 10 January 2019. Okay, so I haven't received any claims, monies for this machine that was completely destroyed. Now they say the averaging clause will not be applied or enforced as the value of the assets in the company was sufficiently insured. Now guys, we're going to do the averaging clause a little bit later on, but what that means, if that isn't applied, it means the insurance company is going to cover your full loss. So you will not incur any losses that you have to bear yourself. So they will pay out whatever the loss was that was incurred by you. No proceeds will be earned should the asset be scrapped because it was completely destroyed by the fire. So it seems to me that this machine has turned into ashes, and now is the question, what now? My year end is 31 December. I still owe the supplier 4 months of installments. I haven't received from the insurance company as yet. They're only going to pay out on the 10th of January. What must I do at year end? Must I still recognize this machine as an asset in my books? Must I still recognize this liability as a liability in my books? Because the machine does not really exist anymore. So what must I do? So the question says, write a memo to the financial manager of Braxit and explain to him in terms of the conceptual framework of 2018 whether the machine that was destroyed by the fire will be recognized as an asset in the statement of financial position as of 31 December 2018. Discuss the applicable recognition and de-recognition criteria as well. And then in the second part, it's all about the outstanding loan amount, whether the outstanding loan amount in respect of the destroyed machine should be recognized in the statement of financial position as at 31 December 2018. Good. So the first part is all about this machine. Must I recognize it or mustn't I recognize it as an asset? And if I say I mustn't recognize it as an asset, obviously I bought this machine here somewhere in October. So at that stage, I would have recognized it as an asset. So it's lying in my books as an asset. Then I must de-recognize the asset. So what is the criteria then if I want to de-recognize the asset? Good, we're going to write a memo. So you're going to address it to the financial manager from a student, de-recognition/recognition of an asset and liability, and the date. Obviously, we always start then with a definition of an asset. An asset is a present economic resource, which means that there's a right that has the potential to produce economic benefits, controlled by the entity as a result of past events. is that machine present? Well, guys, that machine is very present. You can see where it stands is severely damaged. So it is present, but there is no present right to use the machine anymore. Why not? Because the machine is so destroyed, the machine's condition is as such that I cannot use it. So is there any right that has the potential to produce economic benefits? The machine will no longer be able, nor has it the potential to be able to produce future economic benefits to the company. Although the entity has the right to use the asset as they wish, the physical status of the machine is as such that no further economic benefits out of the use of the machine is possible. Does the entity control that machine? Yeah. Braxit controls the asset because they can decide what to do with it. But again, coming back to the fact that that is damage beyond repair, isn't the control now actually something that's meaningless? Because they cannot do anything with it. They can decide, but they cannot kick it alive. So they cannot use it anymore. So the only thing that they can do with it, they have to scrap it and remove it from their premises so that they can do something with that space. So they will scrap the asset and therefore it will not exist anymore, and all further control over the asset will be lost. Consequently, no future benefits can be derived from using the asset. So this control is basically something that exists on paper, but in actual fact, they have lost control over the machine because the machine has lost all its purpose. It does not really exist anymore. Past event, well, when we purchased the asset in October, it was recognized as an asset. So that's when the recognition of the asset took place. But at the date of the fire, when it was so severely destroyed, then derecognition of the asset must happen. The question specifically states that you have to talk about the recognition and the derecognition criteria. So they want you to talk about both of those. So let's talk about the recognition criteria firstly. To recognize an asset, the item must meet the definition criteria of an asset. Now, it no longer meets the definition criteria. It was completely destroyed. No economic benefits will be derived from that, so it doesn't meet that criteria. The second one under recognition is relevance and faithful presentation. Is there any uncertainty about the existence of the machine? Well, guys, you can go and have a look at the ashes. It doesn't really exist anymore, so it is totally not usable. Is there any uncertainty about the flow of future economic benefits? No future economic benefits is going to be derived from the use of the asset. And is there any uncertainty about the value of the asset? Well, it's very certain. If you look at the assets, it's worth nothing. So there's no uncertainty that that asset really no longer exists. So let's have a look at the derecognition criteria now. What is derecognition? It is the removal of all or part of an asset from an entity's statement of financial position. And derecognition occurs when an entity loses control over the asset or part of the asset. Now, the asset has no use anymore. Control is seized and no future economic benefits will be received. Control of the asset must be derecognized mainly as a result of the loss of control over the asset. The asset doesn't exist anymore. So what is our conclusion? The destroyed machine no longer meets the definition criteria of an asset. It, however, meets the derecognition criteria and will therefore not be shown as an asset in the statement of financial position as of 31 December 2018. Then the second part of the question is all about the loan agreement, the outstanding loan amount, so that 4 installments that still has to be made to the supplier of the machine. Guys, can the supplier of the machine, is he any way really worried what the hell has happened to the machine? He couldn't give goods for that. Why not? Guys, you could have made a bonfire with that machine in the first day after you bought that. It's got nothing to do with the supplier. It's not the supplier's machine anymore, so he has no say what you have to do. But let's have a look at the definition of a liability. A liability is a present obligation, and that means it's a responsibility that the entity has no practical ability to avoid. When Braxit signed that purchase contract with the supplier, Braxit and the supplier has undertaken that this purchase price will be repaid to the supplier in 6 installments over a 6-month period. And both of them have signed in agreement to those terms and conditions. Therefore, Braxit cannot avoid this responsibility because it is a legal binding contract. Look at the words, it's important words. It's a legal binding contract. To transfer an economic resource, well, he still has to pay that other 4 installments, so his cash resources is going to reduce when he does that. So therefore, there is transfer economic resource that's going to take place. And the past event was when they signed the purchase contract, which happened in the past. Recognition criteria of a liability. The first thing is, does it meet this element? Does it meet the definition criteria of a liability? Yes, it does. The second thing is all about relevance. Is there any uncertainty about the existence of the liability? No. The contract stipulates the terms and conditions of this purchase agreement. Is there any uncertainty about the flow of economic resources in the future? No, because they will have to repay that at the first of every month according to the contract. Faithful representation. Is there any uncertainty about the amounts that Braxit has to pay the supplier? No. Those amounts are all stipulated out in the loan agreement, and that was based on the purchase price of the machine. So in conclusion, we can now say that liability of the remaining 4 installments that still has to be paid to the supplier must be shown as a liability as at 31 December 2018. And then you're going to end off your story, say, I trust it's clear on the matter now, something similar like that. Yours sincerely, S. Student.